Borrowers are trying to lock in low interest rates in anticipation that the Reserve Bank of Australia will end its low cash rate earlier than its current prediction of 2024. Let's get some business news now. On this emerging story, Scott Phillips, the Chief Investment Officer at the Motley Fool, as he always does, joins us on a Tuesday for his thoughts on this. Is there a storm coming, Scott, to put it simply?
But you introduced Julia before. It's the race that stops the nation. I thought you were coming to me for the RBA decision this afternoon, but it turns out not so much. A storm, probably not, no. But the reality is going to be rates are going up. The banks, of course, get a large minority of their funding from overseas, and those overseas rates are already on the way up. The bond market is betting that rates will increase here, possibly by the end of next year. And, of course, remember, the RBA was kind of expecting that to be 2023, 24. So, yes, it's coming. Yes, it's going to be sooner than the RBA itself expected would be the case, particularly if inflation stays strong. That's what's predicating the whole thing. As you mentioned, mate, look, I've never been strong on one side or the other of the fixed and variable rate debate, but I've got to say right now, if you can get a pretty good variable rate, fixed rate, something under 2% or just over, everyone's different. I can't give advice, of course, but generally speaking, this is a great time to at least be talking to the bank, at least talk to the broker, say, hey, rates are coming up. What can I lock in now? And even if it's a little bit more than the variable rate, it's probably not, by the way. It's probably still less than the variable rate. But even if it's a little bit more, I reckon the odds are pretty good. You'll end up spending less money on interest if you lock it in now.
Yeah, but what's the rub there, Scott? Because is it true then that you can't use your offset as leverage? Or there's got to be a way that benefits the banks, right, for our viewers out there?
So to some degree, Pete, that's absolutely true. You're betting against the bank at one level. At the other level, though, the banks aren't necessarily trying to always beat the borrower. I was going to say screw the borrower, but I won't say that. Aren't always trying to beat the borrower. They're often trying to simply match up the money they can borrow from overseas with what they lend to you, right? Now, if they can fix a fixed rate bond, for example, a government bond or something similar, they can have their own borrowings that they can match against lending to us, they will do so. And at this stage, that's all they want to do is make a margin on that money. So, to some degree, they might be trying to play stuff against each other or off against them. On the other hand, they're simply saying, hey, I can get some cash. I can get some locked-in cash for 3 years at this rate. I can lend it to you at that rate. I'll make a margin on that. Please come and take my deal. And so that's part of it. You're betting against the bond market as much as you are against the banks. This is a situation, though, I think, as you say, where you've got to know what you're doing. The offset isn't always available, so be aware of that. For some people, part fixed, part variable makes sense. You might be able to have a variable component that is roughly the size of your offset, for example, and then have fix the rest. So there's ways of doing it. Again, speak to your broker, speak to your bank, speak to your financial advisor, as always. But it's a really, really good time to have a think about whether or not it's right for you to fix your loan.
Hunt around, because, it does seem as though some out-of-cycle price rises are going to happen at some point, possibly even next year, and perhaps even a few of them. Scott, thank you. Talk to you soon.
Thanks, Peter.
Always good to chat.